Howdy, Jacob here. Today we're looking at Autodesk in the software industry, 46 billion market cap, essentially the same enterprise value. They provide 3D design, engineering, and entertainment technology solutions worldwide. Their growth has been pretty impressive, likely 10% CAGR, 9% CAGR over the last 10 years from 2.5 billion to 5.5 billion. Return on invested capital recently in the 20% range with operating margins of over 20%, gross margin as high as 90%. So cost of goods sold really isn't dampening the business much. They're likely, sales in general is a lot. And then their R&D, they are spending 1.3 billion on research and development with a return on invested capital that is as high as theirs historically. That's likely going to do well for them. And cash from operations, big growth, very low capital expenditures, use of cash, a little bit on reinvestment, quite a bit on acquisition, and then quite a bit on share repurchases. So the last 5 years, you're probably looking at 40% share repurchases, maybe 25% acquisition, 15% investment. I don't know what that ended up to, but that's mainly the use of their free cash flow, and their share repurchases have been going up from 10 years ago. And if we start making some assumptions here, I do think on the revenue growth side, maybe 8% seems pretty reasonable. I think on the PE side, they're not reinvesting everything, but I do think that there is the ability for reinvestment for them. And I do think they'll get great returns there. I mean, the thing that I do like, maybe I'll give them a bigger premium because the R&D is so much. So they're really trying to find different ways to maybe get into different markets, to expand their margin, really increase revenue. And I think I do think that's going to go well for them. On the margin side, I mean, it has been increasing pretty heavily, so I'll probably do a pretty big range here, maybe 20 and 25% with a share change. They've been buying back about as much as they've been, issuing shares through stock-based compensation. And so, I mean, I might assume that it's going to be pretty flat. So again, stock-based compensation gets added to their cash from operations line. And so if they just repurchase, in essence, the number of shares that they're issuing, so you're looking at roughly flat. And I do think that's a fair assumption. And then we just are left with acquisition and reinvestment to get this 8% return in these type of margin. It just looks expensive. Again, no surprise there. You're looking at a current P of 50, and I'm bringing it down to a 20, and growth is not outsubstantiating the discount rate. And so no surprise, we're estimating it needs to fall quite a bit. It's really just math here. Again, you're buying a piece of a business, you're buying future cash flow. Now, could these assumptions be blasphemy? Could it be 15%? Could they have a 50p at that point? I do think so, but I'm looking at history thinking, what type of return would they need to be getting at the end of 7 years for them to have a premium well in excess of 20? I just don't see it being extraordinarily realistic, especially in the fact that over a 7-year period is the average upturn, downturn of a market cycle. And so I think I'm pretty comfortable with these assumptions, and to me the price just looks a bit expensive. But I do hope you enjoy the video and have a great rest of your day.